Hi, everyone, and welcome to Bitcoin Analysis Beyond the Block for November 2025, proudly brought to you by Ainslie Wealth. My name's Chris, and today we have our expert panel with us. We've got Isaac and Joe back for another month, back for our last Beyond the Block for 2025. Lots to discuss this month. How are you going, Joe? How are you going, Isaac?
Doing great. We're definitely at a crossroads in the Bitcoin price. And we say this every video, but I truly think this time, especially for where we are, and we're going to go in the time frames based on everything, we are in a very, very pivotal point in the price, and we're going to be going through that. And I think it's going to be a cracker of a video today.
A cracker of a video today, Joe.
Isaac sounds like he's worked up, so I'll just sit in the back and listen.
Preparing for a Christmas cracker of a video as well. We'll see how that goes. Look, there's a lot to discuss because, as you pointed out, Isaac, we are at that sort of pivotal moment. It's not really dissimilar to what we've been talking about in these videos for a long time. We sort of talked about the potential for October to be really good, and then now that we're into November, we were expecting a little bit of continuation there. Didn't necessarily go as planned, but we'll talk about that in a second. Look, just the overview first, who we are, where we're coming from here. We're representing the Ainslie Group today to talk through really what we've been discussing in our investment committee. I mean, Joe, we had this meeting yesterday. It was quite a feisty one yesterday, actually, aligned with really what we just said, the fact that there is a little bit of confusion in the market. So we get back and forward. We talk that through back and forward in our fund, but we'll go through a few of those things through this presentation today just to really highlight what we were talking about. I know, one point that stuck out to me was, and you can probably elaborate on this, Joe, but when we were talking with Jamie Coots, who's in our investment committee, about getting too cute with the potential for it to keep going down when you have to think it had already dropped 20%. I mean, that was a pretty powerful point.
Yeah, absolutely. And in those moments when it's dropping a lot, it's easy to get quite bearish. And then obviously when it's pumping a lot, you get that euphoric sort of feeling. But markets don't move in straight lines. And from our experience over many years of trading, it's we always fall back on nothing moves in the same direction forever.
So we'll dig into that a bit more because I thought it was a really fascinating discussion. Before we get into the weeds on all of that, just a reminder that everything we say and show in this presentation is intended for general informational purposes, does not take into account your particular circumstances, objectives, or situation, is not financial advice, and you should always do your own research and obtain independent advice before making any investment decisions. We'll use for this final one of 2025, we'll use the same format we have been using all year. We'll sort of look at the big picture macro first, probably get you to talk about that a little bit, Joe. We'll dig into some of the market analysis and the technical analysis that we wrap up with, which is really Isaac's area of expertise, because I think the intersection of all of these is really what the debate is about at the moment. So starting off with that macroeconomic big picture analysis, part of the issue here, Joe, that we were talking about in quite a bit of detail is that the economy is likely to pick up here, right? Like we're actually likely to see, and when we talk about the economy picking up, primarily we talk about the US, but ultimately probably everywhere. We have that aspect sort of picking up globally, but we've got the liquidity cycle, which is the driver of all of that, potentially coming to a bit of an inflection point and potentially slowing down. It makes it challenging.
Yeah, so the reason why we do focus a lot on the US is, generally speaking, a lot of liquidity that's flown into financial markets comes from US liquidity, right? So obviously the other big player in the story is China, but their liquidity generally is more targeted towards the real economy. Now, what we're seeing at the moment is, in terms of where we think US liquidity is going to target over the next 12 to 18 months, is a bit more like what China have been doing with targeting the real economy and that middle class and trying to get the business activity and servicing and manufacturing going again. So that's where a little bit of our concern comes from. Now, when we're talking about liquidity itself, not just the economy, in terms of time and the extent of this cycle, that's where a little bit of our concern is starting to sort of come into place as well. Because in terms of time, we haven't had a steep rise in liquidity, which has given us a clear exit signal. But also we have to, take the other side of the bull argument and think, well, and discuss, as we do every Monday, is that time nearing where we think liquidity may not continue rising at the current rate, or give us a clear blow off top.
And if we look at the macro picture first, before we dig further into that liquidity one, which is really the sticking point, you mentioned that we really are seeing that pickup in growth, or we should see that pickup in growth, because that's what the policy is doing. It's funneling the money that direction. The data seems to be supporting that, right? Like you look at this here, the leading indicator on top is a combination really of forward, so orders for product over the next period ahead, combined with inventory being depleted a little bit, showing that, it's expecting that continues up and to the right there. So that is consistent with that, but that doesn't necessarily mean that we're off to the races in terms of asset prices going up. And we obviously will get to Bitcoin specifically on that, but that I think is going to be a challenging disconnect for people.
Yeah, when you think about how the US government in particular, has tried to stimulate the economy over the past 12 to 15 years, right? They've done it through QE and raising asset prices. QE is direct stimulus to assets because the money flows very, very quickly. And now we're looking at a period of time where the government, like the Treasury and the Fed, seem quite hell-bent on not restarting QE. Yes, they've stopped QT, but they're not really looking to start QE because of those wealth equality issues that are starting to occur in the US. Look at the election of Madani, and which is effectively a socialist in New York. So, if that targeted spending should, and like what we have been predicting for a while, that when you've got that targeted spending into the economy, then it's very realistic to think that the growth and inflation would start to pick up, which would move us into that mid and late cycle indicator.
And that, the other side of that, the inflation, is also looking like it's picking up a bit here. I mean, this is probably a bit of a deeper dive than what we'll do in this particular video, but there are limits to how much the Fed can do if inflation really doesn't even necessarily pick up, but stays up here around that 3% level. I mean, we've had discussions for a long time now suggesting that the 2% line that's there is just out the window. No one's even taking that seriously anymore. That used to be the target. Now they're going, well, maybe it's 3. But if your inflation level is running at 3%, that probably puts a lot of pressure on the Federal Reserve or central banks generally, because let's face it, Australia's rates been running up there as well. That they can't really lower rates in that environment, because you're going to be in a situation where people just aren't getting the interest that's even keeping up with inflation, and that detracts. People aren't going to be buying government bonds. There's lots of flow-on consequences to that, which makes it a real flaw.
Yeah, we've argued that interest rates aren't necessarily the main driver of liquidity anyway. We'll talk about collateral values and the balance sheet of the Fed and whatnot. That's far more important than, or QT or QE is far more important than the nominal rate of interest rates, right? So, but back to your point, we're currently in a rate cutting cycle now, and I think we're up to about 80 or 85% of central banks around the world are cutting. So if you're sitting at that 85%-ish, then like really the rate of change is, generally speaking, would have to be to the downside, because you're already nearly at 100% anyway, right? So generally speaking, rate cuts are assumed, and probably rightly so, good for the economy because it boosts the housing market and all that sort of stuff. But if we're towards the end of that, then I don't really know how much more they can cut rates and stimulate the economy in that sort of fashion, if that makes sense. So we're going to have to lean more into that fiscal spending environment.
And that has been a big source of the discussion for us, is whether that different way that they're now spending the money as opposed to the QE is going to necessarily result in pumping asset prices, which is all going to lead us to the discussion on Bitcoin. But when you look at global equity cycles, I mean, this is our bread and butter. We know we're in the upswing part of one of these cycles, but it doesn't necessarily mean we're going to get a green dot much higher than where we are now. When you zoom in sort of on the data, we're faltering a little bit already. We think we might get one more move higher, and I know we've looked at this chart multiple times, Joe, suggesting that we probably do get one more kick up from there in the rate of change. But we could. There's a lot of indication that we could be closer to the end of this cycle than the beginning. That's for sure.
Yeah, and to be clear, when you say close to the end of the cycle, like you and I agree, and a number of other people that we've spoken to as well, that we still are leaning on the bullish side. But based on where we think liquidity is, the next leg up may potentially be the end of it. And as you pointed out just then as well, liquidity may still continue along, but if the rate of change slows, and then you compound that with the extra money supply growth being targeted at the real economy as opposed to financial markets, that can definitely be a headwind.
And I think I can highlight that point with this chart, sort of overlaying the nominal global liquidity, which has been increasing. This is really important, and we've made this point a few times now. The Bitcoin price here, this was a little bit older now, like it's over a week old. But the point is that global liquidity was still, weekly global liquidity, nominal global liquidity was still increasing up to the right. That's not what we're worried about. We're worried about the rate of change. That's a really important point.
Yeah, absolutely. Absolutely. I've really got nothing more to add to that. But yeah, if you're looking at it from a nominal value and the way that this chart has played out over time, then that's where we're getting our logic behind Bitcoin catching up with liquidity. But also at some point that orange arrow is going to turn lower and it's going to lose momentum. And markets are also forward looking.
And I think I will try to summarize your opinion, but I think it's shared here that we do think that Bitcoin in the short term here is going to do exactly what you just said, catch up with the global liquidity at that nominal level. But that's not really what we're looking at with our concern. It's more what happens after that. Is that a fair assessment?
Yeah, and it's all about planning for what you're going to do when certain thresholds are met, right? So you don't want to be making a plan in the moment because
yes,
emotion will play into those decisions and you'll probably make the wrong decision. So this entire cycle, we've been planning out what we're going to do when X happens. So that's part of the discussion of what we're talking about now.
So if we take that a step further and sort of introduce some of what you've been looking at here with the Bitcoin market analysis into this, Isaac, it is, you mentioned at the start, it's a line in the sand-ish type of time that we're approaching. What is it that's telling you that, particularly if we start here with something you've been talking about every month, the market value to realize value, giving you a bit of indication of how people are going in the market. Are there any signs here that have you concerned? Why do you think we're at this pivotal moment?
I think we're at this pivotal moment specifically based on timeframes. And I know that people don't like to highlight the 4-year cycles, and I do think they are broken to a certain extent. But like you said, with liquidity, if we do catch up and we fail to keep pushing on from there, and then we see that rate of change start to go down, then that's not going to be a good recipe for more upside. And then you'd have to start raising alarm bells. That's why I think, to what Joey said, I do expect a short-term bounce to take place. And from that bounce, that's going to be the point where I think it's going to be very, very pivotal. Because if we do have continuation from there, then yeah, we could absolutely hit those high targets. But other than that, if we don't, I do think we're going to enter a bear market. Now, the bear market will go, I don't talk about blabber on that one too much, but I do think it'll be significantly less than previous bear markets. But if we look straight at the MVRV, well, we can see it's been pretty lackluster performance, can't we? It's been trapped in a range here. And the base expectation when we first started these videos about I think it was a year and a half ago, was that we'd be hitting somewhere around the 4.5 mark. And obviously that hasn't happened. Is there still potential for it? I don't think there is anymore, because you'd have to hit a very nominal high price. And I don't think we have enough time to do that. So you have to adjust based on information.
This is the challenging question that I want to ask you on this, because if you look at that purely, like if you were to draw a line from that top peak 2018 to the next peak sort of 2021 to the peak that we've been through in 2025, that is actually on the trend line, right? Like you could draw a trend line through that.
Good, yeah.
I wonder here if, all this talk we've had for so long about institutional players, that the market changing, we've been saying this, we've been highlighting this the whole time. Do people still expect the old metrics to work when the market has fundamentally changed? Is that is that a genuine concern here that everyone's going, well, no, that can't be the top, for example. I'm not suggesting this is a top, but that can't be the top because it has to go higher. But if the market has changed, why does anything have to happen that way?
Exactly. And I think that same idea can also be applied to altcoins too, because a lot of people still are holding these positions thinking alt season. But the reality is the actual fundamentals have changed. There's now too much supply of altcoins, right? And then there's not enough liquidity to go into that. Because it used to be there was, first run there might have been like a bag of 10 and collective capital flowing into that. Of course, you're going to see absolute appreciation and just Metcalfe's law in that pure number. The fact that now we have thousands and potentially hundreds of thousands, I think there is. It's a spread of capital. Now, the same thing can be applied here. The dynamics have changed. We are now in a more institutional backdrop, and even from a stretched out view on the deviation scores, you can see that very clearly. So you have to pivot with new data, and it means the volatility of this asset is going to go down.
I agree with what, like, a lot of our discussion has been around those Bitcoin top metrics, and I know that there's a few going around with the same as 30 metrics, and not one single one of them are saying that we're at the top. And markets, you've always got to come back to markets. Always find a way to inflict the most pain on the most amount of people.
Yeah.
So it's just not necessarily saying that those indicators are correct or incorrect, but it's always, you just got to have that in the back of your mind.
It's such a good point. I think we need to have that in the back of our mind, as you just said, as we look at all of these indicators going forward, like going through this presentation, because there is potential that some of those metrics have changed, and it wouldn't even be it to me. It's when we look back at it in hindsight. We're in 2027 and we're looking back at what happened. We'll go, well, obviously this indicator or that indicator wouldn't have made any sense because the market had changed. It's not like we didn't know the market had changed at the time. I think people just fall into their comfort zone, probably.
I think, like people just get used to one certain environment and they just refuse to pivot, right? And it's just like, you can see that in a lot of things in life, but especially in markets, it can change as fast.
So, and particularly with markets that are still as young, and we still need to remember that, like we can think a 15-year-old or whatever it is now, market is maturing, but it's still very young. Moving on to the next of this, the fear and greed. I think the fear and greed is probably one of those that that is going to stand the test of time, regardless of what's going on. Because sentiment, oh boy, have we been through some extreme swings this year?
Yeah. Sentiment's one of those things that it's a time old thing. It's not going to change. I do think things that can change with sentiment is how long it drags out and how short it drags out. We've seen different. Well, you can see we've been we've had very choppy ones. We've had very dragged out ones. I would say we're more akin to that range we had for 7 months where we hit the where was it? It was around February, March, around that time, where we then proceed to range for like 7 months, and then sentiment just dragged out so low. Then I think we're entering a very similar thing. That's why I do expect a bounce, even if it's just a local bounce of some sort. It has to come in relatively soon, just based on all those metrics and also the weekly cycles, which we'll go into. But yeah, from a sentiment view, we're slowly just dragging the exhaustion out. So there we go.
And I agree with you. I don't think that's one that's changing anytime soon. I mean, the only threat to that potentially is more sort of AI players in the trading space that will be immune to some of those sentiment things, but then they probably are watching the same indicators as everyone else. So they probably just exaggerate it rather than be fully immune to it. I mean, from your FOMO finder here, I don't think there's any risk of FOMO right now.
Yeah, definitely no risk of FOMO. Yeah, more dragged out sentiment. Nothing crazy like purple. It hasn't been very capitulative, if that's a word, but it hasn't been very, very sharp. We did have that one initial, the largest liquidation event, but since then we've just sort of dragged down opposed to having sharp spikes. So yeah, I think,
and that is interesting too, because the fact that we haven't had those extremes, given some of the sides of the moves, that's probably another piece of information that is changing in the market.
Yeah, I think just overall volatility, and especially, I think it's just going slightly down, and the exaggeration of moves is decreasing, I think.
And I mean, you've put this in there consistently as well, just to keep an eye on it over time. But the Google searches are certainly not indicating any form of peak. they remain elevated from lows a long time ago, but really they're not. There's nothing extreme about that either.
Yeah, and I think this is a metric that I'm probably going to end up taking away soon, because the reality is it's probably a washed up metric, because people already know what Bitcoin is to a certain extent, right? So it's not going to be a very good metric to see interest. So I think that's going to have to be sourced from another source, because if you look at it like this, it's just not the greatest.
It's not giving you really that information. It would at an extreme, but we're just not getting those
Yeah.
extremes. Something that I do think, and you added this sort of this year, is really worthwhile are these funding rates. And it might be worth a bit of an explanation for people again about why these are so informative. But it's they've been picking up again well, we certainly haven't seen a lot of red at these lows. That would be quite positive, I would imagine.
So if you look at the funding rates, you can see obviously, well, basically I'll explain it first of all. So basically, if there's too many longs, we'll start with the long side. If there's too many longs in the market, what that means is those longs have to then pay money to be in those positions. So that's what the funding rate is, and that keeps price very tight towards the spot price, because if you have too much of a deviation, there's a problem, right? So right now, what we're seeing, we haven't, well, especially in this downturn, we haven't seen that much negative funding rate. So the amount of shorts in the market isn't anything outsized, because typically when you do see that, when it goes red, it means it's a very, very good time to buy. So what you would view it as is it's a raw sentiment metric in my eyes. So yeah, there's nothing crazy right now, and we don't need it to be crazy to have a big move to the upside though. We have seen a red spike, but the positive thing is it's not very, very positive funding, so it means there is more potential for the upside, I would say here, because you can see in previous bits when you had peaks, it was accompanied with a very large positive funding rate.
Yeah, but I just think the fact that it is held up during this period is probably quite good as well. Like it really hasn't collapsed. We haven't seen really many of those red spikes. That's interesting to me when you compare it to previous pullbacks. It really shows there are buyers stepping in.
Yeah.
This has been getting a lot of attention online. I've noticed a lot of people talking about this on X. The short term holders, whether they're in profit. Yeah, again, I'm cautious about this, and I really would like your opinion on this, because it is another one to me that may have changed a little bit with the market this time around, and I think there is some informational value there still, absolutely. But a lot of people have been pointing out not so much the short-term holders, but the longer-term holders that have been selling, and maybe that's not so negative as it used to be. I know Joe's going to talk about that a little bit, but what are you seeing here? Could you say this was the capitulation that we needed, or do you think maybe that data is changing in its informational relevance?
I would say, yeah, definitely is changing, and the interrelation between the long-term holders is very important, right? But if you're just looking at specifically in short-term holders, yeah, they are capitulating. But that being said, I do believe, especially as we come later in the cycle, what the long-term holders are doing is very, very important. So I did see there was a large cluster of selling, but that also happened at the previous few peaks too. So it's not like they're just selling now. It's been happening this entire run. It's probably the same reason why it hasn't been parabolic in a sense, right? We still have been
fair.
very, very exponential in a way, but not how it used to be, right? So we have obviously seen that short-term holders capitulate, and that is a sign, a telltale sign that you would expect a bounce of some sort. That's why I've been saying a bounce of some sort is to be expected. Whether we do then take it all-time highs, that is going to be the next video in January. We'll see what happens by then. But yeah, like something's going to come, a bounce is going to come. If we just absolutely nuke from here, that would just very much surprise me, and it wouldn't be my base expectation. Probabilities say we're going to be pushing up, whether it's from 96 around the mid 90s or here.
If we nuke from here, see, when I speak to kite surfers, when the wind is nuking, it's like a really positive thing. So but nuke there, I'm assuming is a negative. I'm just clearly getting out of.
I think crypto Twitter would assume nuke with things are going pretty bad.
Negative, right? Okay, gotcha. I just got to keep up with the kids on this one. Joe, the ETFs, this is not new. You've been covering this for years now, or ever since they came about.
Years.
Years. the focus here is interesting because the flows. I mean, we've highlighted the fastest ever growth and all of that aspect of it. Are you finding that you're getting the informational value from watching the flows at this current juncture?
Yeah, I really do relate to these flows as a lot of what Isaac was talking about in terms of sentiment, right? So if it's sentiment driven, you have to assume that a reasonably large amount of those flows are from retail, because every time the price falls, the flows seem to dry up and turn negative. And then as the price is picking up or sentiment's quite positive, you see the AUM growing over time. Like there's a pretty clear relationship in that. So, and I've spoken about this before. Those initially there was a lot of what we call the basis trade, like short futures, buy spot. But when you're in times such as we are now, and also pointed out in that funding map that Isaac brought along, once that funding collapses, you have to assume that that trade is over, and all that spot Bitcoin that was bought as part of that trade would flow out of the ECS. And I think that's exactly what we've seen now. Doesn't mean that it marks the bottom, but generally speaking, you're closer to the bottom than you are to the top.
And you've spoken about that a number of times, that sort of trade that really is the big institutional trade. Obviously, they're going to be taking advantage of that. It does change some of those metrics that Isaac was talking about in terms of funding, but you can still see that that trade would have been working for a long period of time.
Yeah.
The other thing I'm really keen to get your perspective on is what Isaac was sort of talking about with the short-term funding capitulation. We have seen movement of the bigger, longer term holder accounts. There's different ways to interpret that. Some see that as very negative, saying, oh, well, they've given up. Others say, well, they've made a lot of profit. It now would be a logical time to take some of that. How are you viewing what's going on with the whales?
Yeah, so just to explain this chart, obviously as the market cap of Bitcoin grows, the nominal dollar amount that gets moved around will be higher. So it could be less coins, but the nominal dollar amount is growing. So you need to factor that in when we talk about charts like this. So this is effectively a chart of coins that are over 7 years old, where coins that are worth over $100 million, like as in the transaction size, is in yellow, and coins over $1 billion and transactions over $1 billion are in red. So we've seen over the last, so pretty much most of 2025, huge transaction volumes. So that some people will argue, and fairly well, because a lot of the data is cleaned by Glassnode, but cleaned as in they're sort of drilling down to exactly what's happening with each coin. But there's the assumption that all these coins do go to the exchange to get sold. And that may be true. A lot of them may be, but a lot of them maybe not. Because as you pointed out, if you've got $100 million in Bitcoin or $1 billion in Bitcoin, maybe you don't want it on your hard drive anymore, and you moved it to a custody solution, or you've moved it to an in-kind ETF where you can just deposit the Bitcoin and get issued shares.
Why would they want to move it? Like, because we come from a bullion background. You don't hold it, you don't own it. Why would you want to move it into custody?
Well, a lot of these guys or people who have bought Bitcoin very, very early, they started out with very, very small dollar amounts, and they're obviously very, very wealthy at this point in time. I suppose it'd be a diversification of risk, just in case something was to happen. Like anything could happen, I suppose. Like you could pass away, for example, and no one knows how to get access to the coins you have.
Yeah.
Whereas if it's held by an institution like BitGo or even BlackRock via an ETF or something like that, it's very easy to pass on
do you
that
think,
capital to the next person.
Like, even beyond that, do you think that some of those would be starting to use it in those other ways? Like, I know custody solutions, you've talked for a long time about the potential for lending. Like, is that part of what we're seeing there as well?
Yeah, well, some of them are going to get sold. Like some of these coins are going to get sold, but also remember when you sell something and you've realized that sort of gain, you're going to get a hefty tax bill at the end of the year, right? So there are products that are starting to come out where you can just borrow against your Bitcoin, exactly like your house. So say you got your house paid off and you need some cash for something. Well, your house is worth $1 million. You could easily borrow $300,000 or $400,000 cash against the house. Well, if you've got $1 million worth of Bitcoin, most of these lenders, albeit at a probably a little bit of a steep rate at the moment until the market becomes more competitive, but you can borrow up to 50% of your capital in cash. So if you've got $1 million, borrow 500,000. Rates at the moment are anywhere between 5 and 12%. But like I said, as that becomes more competitive, there's really no need to sell your Bitcoin if you can borrow cash against it. Like if your asset's growing at 20, 25% as a mature asset, which it probably will slow down to, well, you just pay the 5% interest on the loan and you just don't sell it. But you've got a 20% arbitrage there.
Well, and it's more than the 20% because, as you highlight, if you're not paying the tax aspect of that because you're not realizing those gains, like that's for a lot of those people. You think about Australian tax rates for people in that sort of category, they'd be paying 45 cents on the dollar for every bit that they sold.
Absolutely. And when you talk about the people that are moving large amounts of this, their cost base is effectively zero. So they're paying the marginal tax rate on the entire amount.
The other bit I wanted you to dig into a little bit further, this is a really interesting angle, and you've been speaking to me about this, where you're highlighting, well, via the work of Jordi Visser here, but highlighting that it's actually not, it could be a very good thing that these whales are selling for those who are selling, right? So for that aspect, I know we said, they might be using it for other purposes, but for those who are selling, it's ultimately very good. Do you want to talk through that argument a bit? Because I found it quite powerful.
Yeah, so if you think about the concentration of all those coins, like that long-term holder chart of coins that have been held for longer than 7 years, you've got a very, very concentrated user base or holding base, right? So if you've got concentration, then it only takes a few actors to move the price and make it, potentially dump it if it was somewhat coordinated. Whereas if you can, if they were to slowly sell into the market, which is potentially what we're seeing now, then all of a sudden you're diversifying your user base. So you'd probably rather 100,000 people with $1 billion worth of Bitcoin versus 10,000 people with $1 billion worth of Bitcoin because it's 10 times more diversified, right? And that's a lot of what Jordy's talking about. He's comparing it to like an IPO. So say there's a private company and it's done very well. You've got a very concentrated user base or ownership base who want to realize the gains. Like you and I, we are of the Bitcoin maxis sort of mindset. But at some point, like you take chips off the table for your lifestyle. Like you get to the point where it's worth enough money. And it's like, well, what's the difference between 50 million and 500 million? Like in terms of lifestyle, not much. You may as well take some off and start realizing the lifestyle that for the risk you took.
That seems like an absurd statement to make, but the reality is that would be accurate. I mean, even for people who, were working for a job, let's say working at $100,000 a year job, $1 million is 10 years of that wage. So does $2 million at 20 years really make a difference? Like, it does. Like, obviously people's expenses will stand or whatever, but when you think about your lifestyle today, having $1 million and having $2 million, the marginal difference of that reduces the more that's there. And some of these early investors are on extraordinary amounts, like mind-boggling amounts that an extra billion doesn't really make a difference.
No, that's right. And for a lot of people, if they've made $2 million in Bitcoin, for example, and they've got a $300,000 or $400,000 mortgage, which is keeping them in their job that they hate, then like, is it worth waiting for your $2 million to go to $3 million, or is it worth taking chips off the table now and improving your lifestyle right now and paying off the house and going doing what you want to do?
Yeah.
Every situation is different, but like you can see that, particularly now that there is that liquidity in the market to absorb these large sales, which is potentially why it's happening now. There's plenty of logical reasons why it's occurring.
And that's a really good point too about the liquidity being there for it to happen. And I think that ties in nicely with what Isaac was sort of saying before on some of those indicators, because we might in other situations see more extreme moves because the liquidity wasn't there, so people just weren't selling. And when they do sell, that's why you get your 70-80% dumps in Bitcoin.
Yeah,
that might
absolutely
not happen if the liquidity is there on both ends.
Yeah, and the liquidity in the market is the reason why potentially a lot of those long-term holders are selling, but it's also the same reason why we can have an ETF or we can have these treasury companies who are absorbing supply because the market's actually light enough to do that. So you've got to take both sides of the liquidity story when we're talking about market depth. You can't have one without the other.
This is a good spot probably to turn back to some of that technical analysis that you've been looking at the whole time, Isaac, because it is the perfect sort of segue to talk about some of these metrics, which, from a timing perspective at least, and I mean that's you're starting off with these weekly cycles. You've been calling this for a little while, so for several months now, we've been looking at that chart, which will be coming up sort of with the timing bands, and saying, well, the top could be anywhere around here.
Yeah, exactly. Now, so specifically with this metric, every time we'd had a weekly cycle, price would approximately do a double. This specific weekly cycle, we have not seen that. It's actually been very much way less. I don't know the exact percentage, but it has not been double, obviously. If we were to look on an average time basis where you'd expect the next one, we're in that timing window. That's why I'm saying we're in a very important level. The reason being is, first of all, from timing, secondly, from sentiment. So the sentiment's very exhausted coming into this low. You'd expect it to, considering there is a bit of a divergence with global liquidity too. It is like the alligator jaw expression we like to say, it generally likes to close. So on that basis, those three metrics, which I think actually drive the market more than any other tool, right? Liquidity, sentiment, and then cycles. Like that's ultimately the bread and butter of the whole entire thing. You'd be looking at this and be saying, yeah, a bounce is to be expected. Whether we do take out that the low we've just made, or we go up from here. But we're definitely in that window. And then from there, you can see why I'm saying it's very pivotal. We're in a very pivotal point because we absolutely are.
And this is sort of an extension of that discussion as well. And you highlighted this last month. Can you talk us through this again? Because you were sort of highlighting there that it wasn't necessarily behaving in a clear one way or the other, as we were moving into it, and that seems to be what's happened.
Yeah. So when we made the last one, we just had that very large liquidation event, and then price rebounded back up to the mid range. Now this was a indecision section. That's why I highlighted orange in the last time, because it was obviously going to offer some sort of odd price action, which it has. It hasn't just rocketed up since, because a lot of people went on, especially on Twitter, they were saying, "Oh, the largest liquidation event, we're now going to rocket up. Everyone's been cleared," and then we now took out the low. So that's why I was very suspicious of it, because I was thinking, oh, everyone's saying that now, and obviously looking at where we were, we did have some more time in that weekly cycle to pivot out, and then that sentiment shock, that was more of a flash crash sentiment shock, other than a more dragged out. And I'd prefer to see a more dragged out one to actually be conducive of a much more sustainable leg higher, which we are seeing right now. But that being said, I don't know if it's going to be a sustainable leg higher. I do, like I've been saying, I'm going to keep telling that tale. It's going to be local bounce, and if we see any more than that, then we'll go from there. But yeah, we're in that more indecision area in the market structure.
It's interesting too, against the backdrop of what Joe was sort of saying at the start with the liquidity, because it's a very similar picture, which is what you would expect, where we're not entirely sure how that new form of liquidity going directly into the economy is going to play out, and whether it is going to find its way into Bitcoin.
And pretty much every time we had those red boxes, there was a divergence in liquidity. So we had those alligator jaws that were going to close, and we were all looking at people, and even the timeline sentiment was dragged out, and people were saying, "Oh, it might be over, guys." And then we were sitting here looking at the liquidity, thinking, it's most likely not, based on the core metric here. So, and that was obviously earlier on the cycle, so we had more confidence going into that. Now, the more time you extend in the cycle, the more closer we are to the end, right? So that's why I'm very cautious. And I've been leading up into this stage of getting more cautious and progressively going forward.
Well, and I have another thought on that too. It's one thing to talk about sentiment as we have, but also when you think about just the flush out of knowledge, I'll call it. I don't know that that's probably the right term for it, but every man and his dog seems to be talking on X about things like TGA. Like I was using that example. No one prior to a few months ago knew what the Treasury General account was. Like we would do those explanations, and Joe would have to explain it in sort of detailed because no one had a clue what it was. And now everyone's posting, oh, the TGA refill, like that's going to, or the TGA is sitting at this and it's going to be drained and liquidity. They're all using these terms. And it almost is like sentiment. Like when everyone's telling you the same data, it feels like that data probably isn't going to be what actually drives that next metric. I feel people are over analyzing it, over looking, at too closely at some of those things and not consistently. I mean, I would argue we're doing it very consistently, so you get more informational value from that. But that's an interesting one as well.
It's like the edge goes away when mainstream hears about it. Like, you know what's funny? There's that reporter that on Bitcoin. I think her name's Natalie something. She was on one of the CBNC and she was talking about global liquidity. Funny thing is, the moment she went on, we have been following it the same way. So it's like as soon as it goes to mainstream, the edge just disappears. And once people understand it all, right? Which makes sense. But to the point now, you got to be looking at, like you said, on a more zoomed out outlook. Now, on this metrics, the stochastic, we're definitely in the exhausted territory. That being said, we can stay here for a while. We've seen it range here for a while, and it can absolutely do that. But based on everything I'm seeing on a more midterm macro outlook, yeah, local bounce should come. Otherwise, major warning signs. And even if it does absolutely just capitulate from here, which it most likely won't.
Nuke is the word.
Yeah. Nuke's the word. Yeah. Still amazing profits from the low and beats any other market, right? So you can also get too greedy and just expect this thing to keep running up, as a lot of crypto people do. They think they're going to come into crypto and just become millionaires in one day or something. But yeah, very exhausted in the stochastic. That's why all the things I'm seeing are pointing towards what I've been saying in this video.
What about these nodes here? You've talked about this a lot as well, where you do really get that volume, lots of buying and selling at specific levels that does tend to attract the price. Does that give us a somewhat bullish picture as well in the short term, at least, that it needs to return to some of these levels?
Well, right now you can see we've been in a channel since about May. Yeah, about May. So if you zoom it right back out, we're stuck in this value area low, bouncing off between these levels here. We're back in the range. We have the major volume level, which is that red line there too. So I think once you claim that, and you can also see that level has multiple touches, right? So multiple support and resistance touches. If you claim that confidently, you'd be expecting the value area high, which is the other blue line at the top there. And then from there, if you get a rejection from there, then you'd be expecting to go back down, right? So it just depends on how you react off the levels.
Would that blue line at the top be where you would potentially, like if it were the end of the cycle, that potentially would be where the high would sit?
It's a very major level. I think it's going to be there's a few major levels actually, but that's going to be definitely one of them because there is resting liquidity on those highs. But that being said, there's always rest and liquidity everywhere, right? There's highs everywhere where you really, if you can look at a chart and put out a pivot, but it's finding out which highs actually have the residing orders, right? So that's where like volume analysis comes in. Order flow analysis is very useful there because sometimes you'll get lows that don't actually have much substance behind them and they don't end up hitting. But in terms of what we're looking at here, it's not the most bullish outlook right now. I do think once we claim that the red point of control, things will start to look a lot better in terms of a bounce.
But we're not necessarily quite there yet. And when you look at that zoomed in a little bit, similar story or?
Yeah, so just locally, downside, you can see that where we've had a lot of cluster of volume, then that's where price was trading for a bit, and then it obviously had the large move to the upside from there, around 6%, right? The next level, which I've highlighted, I do think it's a very, very important level, is 107,400-ish. There is also a volume weighted average there. There's and the volume node there too, right? So that's gonna be an important level locally to claim, and then there's a few others at the top there. But take it step by step if you're looking at local price action. But I know Joey doesn't like local price action, so we're gonna not go over that too.
Right, we literally just hit 107,400 and it's bounced it back down. So
has it? Oh wow. Let's go.
hit his level. And another one I know that we, Joe and I have looked at this a bit. You look at it as well, Isaac. That's sort of getting really granular on some of this about some of the high liquidation points. We went through. You can't see them now because they're gone. But there was a lot of targets lower that made that quite clear. Probably less clear now because there are targets actually above and below because you've got, people who are coming in long. So to me, it's almost saying it's that build up of liquidity again. Is that how you would view it?
Yeah, definitely a build up. I would say it favors higher, but basically just looking at this off like how much cluster there is. That being said, I haven't actually checked price. So if we've rejected off that level that was it 107,400, and if we go a bit lower, then yeah, a re-entry you could be looking at some of those clusters down there, right? There's a few others, but I don't want to get too in depth today about
Yeah.
that.
And
This video is more
and the
macro.
point,
It's not really
well, no,
day
the
trading.
point is that it really does take out these levels. Like we watch it time and time again. It does go up, it does go down within that bigger picture. So it can make it quite challenging if you don't have the tools available to sort of assess what's going on. Look, that brings us to the end of our formal analysis for 2025. So, it is the end of the year. With the next one that we'll do of these will be in January. So we have what is a traditionally very bullish time over that the Santa Claus rally, all of that sort of stuff ahead of us for the rest of November and into December. I think it would be good to wrap up this month sort of with each person's perspective on what they're sort of expecting to see into the start of 2026, and probably more importantly, what your best case guess is at the moment for where the cycle is likely to end. I'll start because that's always the easiest position because everyone else has to back up on that or disagree. But I think we are closer. I'm probably more on the bearish side here, that there are a lot of indicators. There's a lot we've talked about today that are very supportive for more liquidity to come, all of that. But I think I can't get past some of what Isaac talks about with where we are very late in the timing of these cycles. So even with that extra liquidity, it might just be sideways. I do think we're heading for some volatility ahead. I think we're heading for some form of crash, maybe not over that forward period of the rest of this year that does tend to be seasonally quite bullish. But I do think that would be something I'll be watching out for potentially early next year. And we've just made so much profit from the buy where we were talking about that back in the 10th of January 2023. When you've made so much profit over that period of time, you have to start being a bit cautious when things aren't crystal clear. And I don't think either Joe or Isaac gave us a crystal clear, yes, we're absolutely going up. And we have been saying that earlier in the cycle and most of this year, to be fair. So I think when we're getting that period where it's not so clear, you have to mitigate that accordingly. So that's my sort of view. Isaac, I'll hand over to you.
Yeah, I would say my stance is very clear. I do think what happens from that bounce is the point, and I think next video we do in January, we should have a good idea by then, right? We might have some surprise during Christmas as the market might do something absolutely wild, but January time, I think by then we'll have a good idea because that's 2 months from now. Yeah, we should if the bull or bear market's done by then. So yeah, we'll update you then, guys. Stay tuned.
Joe, are we decorating the tree with Bitcoin baubles? Are we, going into a deep bear market, so we need to protect ourselves from the snow? How are you seeing this?
I was really laughing because the ball was a little Bitcoin. So as soon as you pulled that slide up, I'm like, oh dear. No, I agree with most of those points. I think to capitulate around 100,000 or 100, where we are now is probably not the right time to be selling out. I think we'll probably get a reasonable exit price in the next 6 to 8 weeks, potentially even into the new year. So it's still quite positive in that time frame. But after that, as we pointed out, based on our liquidity metrics and that, we just don't know where that additional liquidity momentum is going to come from. So, it comes back to that lifestyle stuff we spoke about before. It's not just for the whales, it's for everyone else. If you feel like you've made a good chunk of money on the next leg up, if it eventuates, it's probably not a bad idea to pull some of those lifestyle chips and just ride out whatever else happens.
And if we're wrong on that, and the price continues to rocket because there is a new form of, or the liquidity comes through in a way we weren't quite expecting, we'll be following that and we'll pay attention to that as it changes. But now, sort of saying on the balance of probabilities, we're getting closer to the end. You just want to be cautious, because I think people forget that actually where you make all your money is in a bear market by not being in it, because that allows you to buy the cheap, start the whole process again, right? Like that's the plan.
Absolutely. And, based on the 4-year cycle, that can be quite a extensive time frame. But in terms of your entire investing life, 4 years is not a long time if you can get that right.
Very true. Look, thank you both for a wonderful year of pulling all this information together. I know our audience really appreciates that. We will, as I said, be back in January to see where we're at, see how all of this fits together. So thank you, Joe. Thank you, Isaac. Thank you, everyone, for watching. Have a very Merry Christmas, a wonderful New Year, and we'll see you probably towards the mid-January sometime to assess how it's all going then. So thanks all, and we'll see you then.